Why do the wealthy continue to get wealthier even as global economies experience turbulence, inflation, and shifting public markets? While many factors contribute to this persistent pattern, one key driver stands out: private equity. Welcome to ProBest Analytics, your go-to channel for breaking down the hidden forces shaping global finance. If you're passionate about understanding how wealth is built, protected, and multiplied, you're in the right place. This often overlooked corner of the financial world not only creates opportunity for outsized gains, but also serves as a powerful engine, consolidating and multiplying the fortunes of high net worth individuals and families. To truly understand modern wealth accumulation, one must delve beneath the surface of public markets, into the strategic mechanisms, risks, rewards, and exclusive communities that characterize private equity investing. At its core, private equity refers to investment in companies whose shares are not traded on public exchanges. Unlike public equities listed on stock markets, these businesses raise capital through private offerings, often through funds managed by specialized firms. The universe of private equity is vast. It encompasses everything from venture capital backing fledgling startups to buyouts of mature businesses to investments in distressed debt and turnarounds. It's a world marked by active ownership, direct influence on company strategy, and a relentless focus on value creation over multi-year timeframes. A private equity fund is typically structured as a closed-end limited partnership. Two main groups form the heart of this structure. General partner is the professional investment manager responsible for strategy, deal sourcing, due diligence, management of portfolio companies, and ultimately, exits. And limited partners, investors who commit capital to the fund, drawn from a pool of high net worth individuals, family offices, pension funds, endowments, insurance companies, and sovereign wealth funds. Once pooled, this capital is deployed into carefully selected private firms. The overarching goal is to transform these companies operationally, financially, and strategically so that at exit, their value has increased substantially, enabling impressive returns for all involved. And general partner is the architect and executor of the fund's vision. Their responsibilities include fundraising, deal sourcing and acquisition, active management, and last, exit planning. Crucially, general partner assume unlimited legal liability for the debts and actions of the partnership. In practice, this risk is contained within a separate legal entity, usually a limited liability company. For ultra-wealthy individuals and institutions, the appeal is clear: access to potentially high-return, low-correlation opportunities, without the time or expertise required for direct management. Private equity funds have proven to be a powerful engine of wealth accumulation for the rich, offering both outsized returns and unique portfolio advantages. Several core mechanisms undergird this wealth-amplifying effect. Private equity investment has historically outpaced returns from public equity markets, especially when measured across multi-year periods and net of fees. Let's explain this with an example. If an investor allocates $100 to both private equity and the S&P 500, the outcomes over a 10-year horizon diverge meaningfully. The private equity investment grows to $415, reflecting a 15.3% compound annual growth rate. The S&P 500 investment grows to $338, corresponding to a 13.0% compound annual growth rate. This comparison highlights that private equity delivers an excess return, or alpha, of approximately 2.3% relative to the public market benchmark. Why private equity remains a playground for the wealthy, despite its documented success and the allure of superior returns. Private equity remains largely inaccessible to the general public. Multiple barriers maintain its status as a fortress for the wealthy. The conventional private equity fund typically demands minimum commitments ranging from $250,000 to several million. Such thresholds are deliberately set to target large institutional investors and ultra-high net worth individuals, excluding all but the financially elite. This approach serves several functions. First is operational efficiency. Due to large minimums, allow funds to reach effective scale quickly, reducing administrative overheads tied to managing numerous small investors. Second is investor sophistication, where funds often use high minimums as a proxy for financial sophistication and risk tolerance, presuming that those capable of making large commitments better understand and can absorb the risks involved. Last but not least, regulatory compliance, where securities laws often restrict private placements to accredited or qualified investors who meet specific wealth or income standards in order to protect financially vulnerable individuals from illiquid, high-risk investments. Leverage and alpha generation in private equity. A defining feature of private equity, especially in buyout strategies, is the aggressive use of leverage to finance acquisitions. In a typical leveraged buyout, the fund invests a portion of its own equity and borrows the rest, often 60 to 80% of the purchase price. This leverages not only increases potential upside, but also amplifies risk. Let's break down how private equity uses leverage to amplify returns. Imagine a company is purchased for $100 million. The private equity firm puts in $30 million of its own equity and borrows the remaining $70 million as debt. Now, what happens if the company's value changes? If the company grows by just 10%, its value rises to $110 million. After paying back the $70 million in debt, the equity holders are left with $40 million. That means their original $30 million has grown to $40, a profit of $10 million or a 33% return. Notice how a modest 10% growth in the company translates into more than triple that for the investors. But leverage cuts both ways. If the company's value falls by 10%, it drops to $90 million. After repaying the $70 million debt, equity holders are left with only $20 million. Their $30 million investment has shrunk by a third, a negative 33% return. That's the power and the danger of leverage in private equity. Small changes in company value can create outsized gains or wipe out equity just as quickly. In short, leverage magnifies outcomes. It's the double-edged sword that makes private equity both so attractive and so risky. Because of these barriers, most people cannot access private equity as a tool for wealth creation. The result is clear. Wealthy families continue to grow their fortunes, fueled by the high-risk appetite that private equity demands. And that's why private equity remains the domain of the few. Thank you for watching this video, and if you found value in this breakdown, subscribe to ProBest Analytics for more in-depth explorations of the forces shaping global finance.